Hi everyone. I've been looking at option strategies to see what I can make work and what I can't make work. One of the first ones I did um, was was I speculated that um, oil is going to move a long way, but I didn't know whether it's going to go up or down. So I thought, okay, let's open a straddle. So that's buying a call and a put at the same strike price. So I bought that um, against the USD CAD because the Canadian dollar is highly influenced by the oil price. So here it was. I opened it on the 25th of Jan, but I closed it on the 9th of Feb. Um, Cost me $906. I closed it for $911, so I didn't make or lose anything on there. But between the 25th of Jan and the 9th of Feb, if we look at what happened, so here's the 25th of Jan. There's the USD CAD bar. So say take worst case scenario, I got in at 1.4136. Then 9th of Feb, I closed it. So that is this one. Say 1.3915. That's about 200 pips. So the market moved 200 pips and I didn't make any money. So the fact that I had with the straddle option, you're buying a put and a call. You know either the put or the call is going to expire worthless. So it becomes, I think it's quite an expensive strategy. Now, even though it's theoretically you can make money as long as the market moves in any direction, but I've been reading about this and I've been reading that to make that to make money on that, you should be looking for setups where initially there's low volatility, so that the actual price of the options is lower because one of the factors that influence its option price is volatility. The higher volatility, the more likely the option is going to reach the price you want it to, so the more expensive it's going to be. So, so you want to enter that strategy with low volatility before an event that you think will cause a big price move. So where am I now then? So I think I'll avoid things like straddles for the time being, and I'll stick to simple positions. The other thing that I've been looking at is instead of just buying a simple put or a simple call, um, my one of my current positions, where is it? Here we go. I've got a position of the pound against the yen. So here I bought a call, but I've sold a put at a higher strike price just to get some money back, so that it makes actually my position cheaper. But the strike price I sold the put at is my target for for where I'm aiming for. So as long as I hit my target, I'm happy. So the fact that above that target, I don't make any more money, doesn't matter. I'll just close my position at that target. So maybe that's a good strategy to follow. But I'll keep trying, and then once I get some sort of consistency, I'll start recording details of all my options trades, and I'll be doing it in a live account. The thing I really like about options though is if you're trading the spot market, you have to use a stop, and in volatile conditions, your stop can be hit. So you're out of your position, but then it can be moved back in your direction and ultimately hit your target. With options, the maximum you're risking is what you've paid for the option premium, and the market can swing as far against you as it wants. But then if it goes back in your favour, you're still in that position, so you can't get stopped out. But you still got a fixed amount of risk. So that's one thing I really like about options. The other thing I really like about options is the fact that um, I'm not trying to time the market so much. I don't want to be staring at screens all day long, and I can't anyway. So usually I want to make my decisions first thing in the morning or last thing at night. So I like the fact that I don't have to worry about market volatility, about specific entry points. I can just take a more long-term fundamental view and enter my positions, and that's it. I'd have to think about them, or I can review them once a day. So yeah, I'm really keen on making options work, but let's see. So watch this space.